Have you ever looked at a really big company and just wondered, how do they figure out their total value? I mean, how do they build their entire financial foundation from the ground up? Well, that's exactly what we're going to break down today.
You see, the whole secret, it really comes down to one powerful concept, capitalization. And trust me, understanding this is absolutely crucial, not just to pass your BCom exams, but to really get how the business world actually ticks.
Hello students, I am Santosh Chavan, and a very warm welcome to my YouTube channel, Easy Commerce with Santosh. In today's lecture, we're going to decode the entire topic of capitalization step by step in a really simple way that I promise will make you feel confident for your exams. So here's our game plan. We'll start with the absolute basics. Then we'll jump into the two main theories. After that, we'll look at what happens when things go wrong, the problems, and of course, the solutions. We'll even solve a practical problem and wrap it all up with a quick revision. So let's dive right in.
Okay, first things first, what exactly is capitalization? I want you to think of it as the financial bedrock, the very foundation upon which a company is built.
So the most important word here is long-term. Capitalization is the grand total of all the long-term money a company has to work with. This includes money it owns, like share capital and reserves, and also money it has borrowed for the long haul, like debentures and loans. It's the permanent financial backbone of the firm. Right. Now, the big question is, how does a company even decide how much capital it needs? Well, there are two main schools of thought, two main theories for this, and please pay close attention here, because this is a very, very important topic for your exams. Let's break them down. The first one is the cost theory, and it's actually very simple, very logical. It just says that a company's capitalization is the total money you need to get the business up and running. So you add up the cost of all your assets, the money for your daily operations, that's working capital, and all those initial promotion expenses. This method is perfect for a new company trying to figure out how much money it needs to raise. Let's take a quick example to make this crystal clear. Imagine a new company needs 90 lakhs for its machinery and buildings, another 1.5 lakhs for initial advertising, and 10.5 lakhs for other setup costs. You just add them all up, and its total capitalization, according to this cost theory, would be 102.50 lakhs. Simple, right? But, and this is a big but, this theory has a major flaw. It only looks backwards at the costs. It completely ignores the most important thing about a business, its ability to earn profits. So even if the company starts making huge losses, its capitalization value on paper doesn't change. It's stuck in the past.
And that's exactly why we have the second, more modern theory, the earnings theory. This one flips the whole idea around. It says a company's value isn't what it costs to build, it's what it can earn in the future. The formula is quite straightforward. You take the expected annual profit and you capitalize it using the normal rate of return for that industry. This is much, much better for existing running companies. For example, let's say a company expects to earn 75,000 rupees every year, and in its industry, a 10% return on investment is considered normal. So, using our formula, we can figure out its value. Its capitalization should be 7.5 million rupees. See, this value is directly tied to how well the company is performing.
Now, the challenge here, well, it's all based on predictions, on estimations. If you get your profit forecast wrong, or if you pick the wrong rate of return, your entire calculation goes haywire. And of course, for a brand new company that has never made a profit, trying to use this theory is just too risky.
Now students, this slide is exam gold. Please remember this comparison. Cost theory, it's all about past costs and it's for new firms. Earnings theory, it's all about future earnings and it's for existing firms. One gives you a solid number, but it's static. The other reflects the company's true worth, but it's based on estimates. This is a very common question.
So what happens when a company gets this whole capitalization thing wrong? Well, it can lead to two major financial sicknesses, if you will. You can either have too much capital or you can have too little. Let's look at both these problems.
First up, we have overcapitalization. In simple words, this means the company has raised far too much money for the amount of profit it's actually making. The earnings are just too low to justify such a huge capital investment. And for your exams, the key test is this. The book value per share is greater than the real value per share. Now, how does this happen? Well, maybe the company paid way too much for its assets, or maybe it's been a fortune on promotion without getting results. And the effects? They're really bad. The share price starts to fall, the company's reputation and credit rating take a hit, and shareholders get very unhappy with irregular dividends. It's a lose-lose situation.
Now, the opposite problem is undercapitalization. And this might sound like a good thing, right?
but it comes with its own set of challenges. It means the company's making massive profits with a surprisingly small amount of capital. And here, the test is the exact opposite. The real value per share is much, much greater than the book value. This usually happens when a company is just incredibly efficient, or maybe it just underestimated how profitable it would be. Now, shareholders absolutely love this. It means high dividends and a soaring share price. But it's like a magnet for new competitors. And it can also lead to employees demanding much higher wages, which can cause a lot of internal conflict.
So if a company is sick with either of these conditions, what's the cure? And what's that ideal, perfectly healthy state that it should be aiming for? Let's find out.
To cure overcapitalization, a company needs to take some serious, tough steps. It basically has two options: either increase its earnings or reduce its capital. It can try to become more efficient, it can refinance expensive loans, or it can even buy back its own shares from the market to shrink that oversized capital base.
And all of this hard work is to reach one goal: fair capitalization. This is the sweet spot, the perfect balance where the capital is just right for the company's earning power. In this ideal world, the book value per share perfectly equals the real value per share. This is the healthy state every company strives for.
Okay, enough theory. Let's put this into practice. I can almost guarantee that in your exams, you'll get a numerical problem where you have to calculate whether a company is over, under, or fairly capitalized. So let's walk through the exact steps to solve it.
It's a simple two-step process. Step 1, you calculate the book value per share. This is just the company's net worth on paper divided by the number of shares. Step 2, you calculate the real value per share. This is based on its actual earnings, and it tells you what the share should be worth based on its performance.
Once you have both these values, giving the final verdict is easy. Just compare them. If book value is more than real value, it's a clear case of overcapitalization. If real value is more, it's undercapitalized. And if, by some magic, they are equal, the company has achieved fair capitalization. Just remember these 3 simple rules.
All right, we have covered a huge amount of ground today. So before we wrap up, let's do a quick rapid-fire revision of the most important points. This will help lock them in your memory for the exam.
Ready? Let's go. First, capitalization is the total long-term funds of a company. The cost theory is based on initial setup costs and is best for new firms. The earnings theory is based on profit potential and is used for existing firms. Got it?
Next, the 3 states. Overcapitalization means too much capital for the profit, where book value is greater than real value. Undercapitalization is the opposite, too little capital for high profit, where real value is greater. And fair capitalization is that perfect ideal balance, where both values are equal.
So to conclude, I want you to remember this one key idea. A great company doesn't just try to raise the most money. It raises the right amount of money to support its earning power. And mastering this delicate balance is really the essence of good financial management.
So, if you found this lecture helpful and easy to understand, please don't forget to like, share, and subscribe to Easy Commerce with Santosh for more such easy and engaging commerce lectures. I wish you all the very best for your exam.